Welcome back to another episode of Ask George, where we are going to talk about managing the financial side of a dental practice. And, this is definitely, I think even before we jump into the episode, I want to just maybe tell my personal story on the topic, because I would say the topic of dental finance is one that, so I would say the first half of my career, I was very revenue focused. And so I felt like I was quite naturally talented at something that a lot of entrepreneurs are good at, which is driving revenue, right? Understanding like, okay, adding more providers, getting more patients, expanding to another location, that type of thing, right? Like finding ways to grow your total productions collections. What I don't think I was as disciplined about was controlling my costs and really understanding profitability at a deep level. And so, in 2022, which is now coming up on 4 years ago, I became the CFO. And that was really the place where I learned. I sort of took what was a weakness and then sort of made it a strength. So from my perspective, that is sort of my path in this financial world. And, something that comes up in the mastermind quite often when we have our mastermind calls is this recurring frustration that dentists feel where they're like, okay, my practice is busier, my productions collections are higher, but the business bank account doesn't move the way that I'd like it to. And I think that this is like a really common frustration nowadays. And what's interesting sometimes is you'll look at a report from your accountant, and sometimes the report will show like a lot of profit, but then when you go look at the bank account, you're like, where is it? Or maybe your accountant is accurately reporting it and there just isn't a lot of profit, or maybe there is, right? But I think that this is one of those topics that just requires us to go a little bit deeper. And so I think that the first thing I want to talk about is just like the high level kind of financial statements, so to speak. And so, in finance, there are sort of three core statements. There is the income statement, there is the balance sheet, and then there is a cash flow statement. And like realistically, for a solo operator of a dental office, like you're not going to need to like look at these three financial statements on a monthly basis. However, I do think this lens is important because as we introduce this idea of talking about the financial side of the practice, I would just like to talk to you about the different statements. And so you have your income statement, your profit and loss, your P&L. And this is going to be the statement that 90% of you or more are going to look at on a routine basis and maybe nothing else, right? Your accountant usually sends it the following month. Depending on who you're using for accounting, it might be a different cadence. And this is where you're going to see, okay, my collections, right? So the first thing you need to talk about, and this is kind of an interesting point, is your collections is not necessarily what shows up as your revenue on your accounting statement. On your accounting statement, the accountant calls your deposits your revenue. And so there is this thing that you look at in your accounting statement where you say, okay, well, what collections did I have? What did the practice management report as collections? And then what is coming in deposits? And there's a reason why this is important, because a couple of times there's going to be some mismatches. Like, so for example, let's just say it's the end of the year. And, like end of the year, you're going to be maybe filing a lot of insurance checks on behalf of patients to get them in. Maybe you have some team members working, on the 30th and 31st, trying to get a lot of checks in. And then all of a sudden the calendar turns to the 1st, and then those checks don't clear and hit your bank account until the 1st or the 2nd, but your office manager or whoever does your, payment posting might put it in as collections on the 30th of December, right? So there's going to be this mismatch at times with the practice management saying collections is this, and your financial accountant saying that your revenue is different, right? So that is based on the fact that when your accountant does your profit and loss, they call bank deposits. That is your revenue. And sometimes there's a mismatch between when you collect the money and when you actually get the money showing up in the account as deposit. And so there's going to be that discrepancy kind of at the tail end of the months. The beginning of a month and the end of a month, there's going to be some mismatch where if you have like a big collections day at the end of the month, then maybe your collections are going to be significantly higher than your bank deposits. Outside of that, outside of the abnormal things, your bank deposits are your revenue according to your accountant. So that's just kind of an important thing to establish. And then you have your expenses, right? And we're going to go through expenses on its own. So like I'm going to kind of brush past it just for the initial conversation about introducing the income statement. So you're going to look at your expenses and then you're going to be able to see your income. And that's going to be sort of the purpose of the profit and loss, which is why it's called an income statement. It shows you your income. And that's usually for a period of time. So that's an important look. And also what you can get from your profit and loss or your income statement is your EBITDA, right? Which is your earnings before interest, taxes, depreciation, and amortization, which is really just the sort of the metric that you use to financially value your practice to see how much your practice is worth. And just a quick note on EBITDA is you're going to need to add back the doctor compensation piece. So you have to pay yourself as an associate before you can calculate your EBITDA. So if you're a solo operator and you don't have any doctor compensation expenditures, then you're not really looking at your EBITDA, right? So if you look at it, you're like, oh, I'm 50% profit. That doesn't mean you're 50% EBITDA, right? So just a small note, but not necessarily nor here nor there. So that's the income statement, right? The high level things that we talked about are your collections, is what your practice management says you collected, but your income statement, the revenue on it, is bank deposits that your checking account, your business checking account received that month. Then the next thing is you're going to see your income or your EBITDA, and that's going to be kind of what you glean from it, and then all of your expenses are going to be shown there as well. So that's the income statement. Moving on to the balance sheet. So the balance sheet is, I would say the balance sheet can get real confusing real fast. And so I would say that the only thing that I want, this is like an introductory conversation, right? So I would say the balance sheet, most of it is not applicable to you, but I would say what is applicable to you is what I would call your current assets and your current liabilities. And so this is really a function of your current liabilities or like your credit card debt, your practice note payment on a monthly basis, like essentially like on a short-term window, what obligations do you have on debt that you have? And so really your cash on hand is going to be extremely important. And so like your total liquidity or like the amount of liquid cash that your business has in it, in the operating account, is your cash on hand minus your credit card bill, right? That's going to be kind of the accounting term that's going to really determine how much liquidity you have in your business bank account. And I'm oversimplifying this, but like just I'm here to make this clear, not to make it thorough and accurate and complete, right? Because it's just not the purpose of this episode. And so like the thing that you need to think about with your balance sheet is you need to think about how much cash do I have in the business bank account and do I have a responsible amount? And candidly, I've seen dentists miss on both sides. So I've seen some dentists that have like a year's worth of profit just sitting in the account and they just don't know what to do with it. So they just let it accumulate and they just have like hundreds of thousands of dollars more than the amount of money they need in the account. That's one extreme. And then I have the other extreme where the dentist has about a half or a third of what they need in the account. And what that's going to do is that's going to create stress around payroll and around credit card bills and around like just your regular operating expenses. So what is the correct amount of money to have in liquidity? The correct amount, and there is no like, obviously there's pros and cons to any amount, but I would say the highly recommended amount that is pretty widely discussed in the industry is 1 month's break-even point. So you say, okay, totaling all expenditures for a given month. So like total outflows of your bank account on a monthly basis on average is what? And that includes your overhead plus your practice note plus, whatever other money leaves your account on a monthly basis. And, the easiest way to look at that is your bank statements. So your bank statements will show income, outflow, income, outflow, income, outflow. And you go look at the last 6 months and you say, how much money is leaving my checking account? Now, exclude payments to yourself on this, right? Because we're getting to how to pay yourself. But like on a quarterly basis, you should probably issue yourself a payment to bring the account balance back to this, 1 month's break-even number. So you take those out, right? Because that will skew this math. But then you look at it and you say, okay, like how much, right? So it's really your overhead plus your debt service is most commonly the answer for people. And that's how much money you should have in the bank account at all times. And what that allows you to do, if you think about what a month's expenses look like, there is rent at the beginning of the month. Then there's, if you're doing payroll on the 15th and the 30th, then you're going to have payroll in the middle of the month and you're going to have payroll at the end of the month. One thing I will say, and this is maybe we're talking about cash flow a little bit here, but payroll on the 15th and the 30th is a really good idea, because if you don't do that and you do biweekly, what occurs is there will be these 2 months out of the year, every year, where you have 3 payrolls, where it's just so lines up that the days work out such that you have 3 payroll days in a given month. And those months are very hard. It's very hard to be profitable when you're running 3 payrolls in a month. And so it's a lot easier to have much more consistent and stable profitability when you're spreading out those payrolls more evenly, right? Because what's really happening is if you have 3 payrolls in a given month, one of those payrolls is a payroll from the prior period, from the month prior. And so you can see like the finance talk is like kind of like coming out of me on accident. And so what you're really doing is you're kind of like underpaying payroll by a little bit every other month, because you're doing it in 2-week cycles. So you're doing it for 28 days when most months are 30 days or more. And so what that ends up doing is you end up like a little bit at a time skimping on payroll month over month, and then the bill comes due twice per year when you have 3 payroll cycles in that month. And so the simplest solution to this is moving towards the 15th and the 30th. So that way it's not like any other, biweekly thing. It's just the 15th and the 30th. There's 2 days per month. And that will increase your staff expenses on the 10 months that don't have 3 payrolls, and then it'll drastically reduce the expense on the 2 months that you have 3 payrolls. And so this ends up becoming a really helpful tactic, because you are avoiding 2 months that those payrolls really hurt you. Long story short here, the amount of operating balance you want should be kind of that 1 month's break even, because you're going to have your rent and your loan payment, and maybe your monthly subscriptions come out at the beginning of the month. Then in the middle of the month, you're going to have your payroll. And then at the end of the month, you're going to have some credit card statements, and you're also going to have maybe your payroll come out at the end, right? So like there's kind of these 3 points in the month, the beginning, the middle, and the end, that a lot of cash is coming out. And so what happens to the bank account balance is it starts at a specific level, and then it goes down, and then it trends up, and then it comes back down, and then it trends back up, and then it goes back down. And then you want, at the end of those waves, you want to have never run out of cash. So you're never having to wire money into the account to cover payroll, to cover the credit card expense, or to cover anything. And you want to end up with more cash at the end of the month than you had at the beginning of the month. So it's like within that up and down, in net, we went up a little bit at the very end of the whole thing. And so that's like kind of how the cash should flow, which is, I think, moving us towards the cash flow statement, which is strictly looking at what is happening with the cash. And there's kind of a cash flow statement has some elements to it. So you would say, okay, well, like what is the income that we got from operations? That's the first part of a cash flow statement. So like that's your overhead analysis without debt service, is your income from operating the business. Like what did the profit and loss say you made before paying the bank? That is your operating income. And then there's what we call financing activities. So that is paying the bank back, right? Because a lot of you guys who got into ownership have debt associated with that. Whether you did a startup and you got a startup loan, or you did an acquisition, you got a loan to acquire, most of us have debt on the office. And so that debt payment comes out, and that's considered a financing activity. And then the third thing on a cash flow statement is considered an investing activity. So let's just say you had a month where your income was $40,000, your debt payment was $10,000, then your cash flow would be $30,000, right? The cash flow statement would say we increased cash by $30,000. But let's say this month you had you decided to remodel the office, and you decided to spend $50,000 on like just making it all beautiful, and you just paid the contractor $50,000, they did paint, floors, you did some stuff, you bought furniture, whatever, right? Then it'd be kind of confusing because you'd be like, well, I worked the whole month and I made 40,000. I paid 10,000 to the bank. So then I have 30,000, I spent 50. So it's like your bank account went down 20,000. So you're thinking like, am I running an unprofitable business? Well, what the cash flow statement allows you to do is it allows you to say, well, my business made 40,000. I had a financing activity where I had to pay the bank back 10,000. And then I invested 50,000 into the office. So my cash went down by 20,000, but the income was actually 40,000, right? So the cash flow statement is intended to help you understand where is the cash going. And there's kind of an important element of this, which is oftentimes, especially new owners, they get themselves in the situation where they just want to make money, spend money, make money, spend money. And it's like they're not holding on to their earnings. They're reinvesting their earnings in a new computer and in this equipment and in a CT scan or like a CT scan, like a cone beam, or they're getting small equipment, or they're getting marketing, or they're hiring another team member, right? So it's like what happens in early ownership is you walk into a practice and you see like all of these projects that you have to do, and they all cost money, right? Well, what the cash flow statement is intended to do is the cash flow statement is intended for you to understand that your practice generates an income. You then pay back the bank on a monthly basis in that debt service for your loan. That's a financing activity. And then all of the one-time payments and the change the carpets, do the paint, make the office look nice, buy computers and go digital, like all of the things that you're doing, those are investments that you're making in the practice. And so there's a section called investment activities. So those are the three financial statements: an income statement, a balance sheet, and a cash flow statement. And the income statements, the purpose is for you to know your income. The balance sheet, the purpose is for you to have enough cash to weather the random volatility and to make sure that you have a healthy business. And then the cash flow statement's purpose is for you to understand why is the cash on hand going up or down or staying the same. Whatever is happening to the cash from the beginning of the month to the end of the month, or from the beginning of the year to the end of the year, the cash flow statement's purpose is to teach you and tell that story so that one-time expenditures and debt service are being properly counted for, and then you can see what the business is generating versus what's going back to pay back debts or what's being invested in the practice. And there's something I talk about commonly with people on the mastermind calls that we, naturally on the mastermind calls, we do talk about money a fair amount. And so when it comes up, one of the things I like to talk about, especially to new owners, is I like to say, hey guys, make money, make money, save money, then spend money, right? Because what happens is if you're just like in this constant act of buying stuff, then you're never actually letting the money accumulate. And so what I suggest is to go a whole quarter and to let the money build up. And then you say, okay, for 3 months in a row, I had this income, I paid this back to the bank, and I had this much cash accumulate in my bank account. And then the following month, I had this income, I paid this back to the bank, and this much more accumulated into my account. And then a third month, I made this, I had this, go to the bank, or I had this income, I had this go to the bank, and I had this accumulate in my account. And then I have 3 consecutive months of accumulating money. And now I'm sitting on an extra $60,000 or whatever, right? And then you say, okay, the $60,000, now that's my increase on cash on hand. And I recommend a quarterly basis for this. So you do it every 3 months. You just let the money pile up, and then you decide at the end of the 3 months, what do I do with it? And the options are, I can do a distribution, which means pay it to myself. And then you can, you're going to have to pay taxes, which is actually something, a small note, is you have to pay taxes on the profit, whether you distribute it or not. So if you were to just decide you think I don't want to pay taxes on my money, so I'm just going to accumulate it in the business bank account and not pay it to myself. That doesn't work, because you pay taxes on your profit, whether it's in the business bank account or it's in your personal bank account. So you can choose to do a distribution and pay yourself that money, or you can choose to keep it if you want to grow your liquidity in the business bank account, let's just say you need to add more balance, or you could invest it. And you could, for some of those investments, you're going to have tax deductions, right? So like, let's just say I'm investing it in furniture and, some marketing or something, like all of that's the tax deductible. So then you're going to reduce your tax liability because you're reducing your earnings by investing some of your built up earnings before the year ends. So that's kind of, the different decisions, right? And I think that the owners that do this very well, they pay themselves some salary, whether it's a percentage of their production or it's just a fixed amount. They're going to get that on the biweekly payroll. They're going to have some taxes withheld. And then on a quarterly basis, they're going to accumulate additional money, and then they're going to decide what to do with it. And so that's kind of like, when done well, what that looks like. And that's where, you as the owner operator, you need to figure out, what is the best use of my cash? So like, is my cash best spent with, investing it in the practice? Or is it better for me to take it out and invest it personally, right? And so I would say in most situations, your practice is going to offer a higher return and it's more tax efficient. Because if you have some accumulated earnings, then you say like, okay, I have $40,000 here, and I could spend $20,000 equipping another operatory, or I could take that $20,000 out and pay taxes on it, and then invest it in the S&P 500, for example. And you'd say, okay, well, what am I most likely to get a better return on, right? My $20,000 that I put in a new operatory, a portion or a majority, depending, talk to your accountant about how much of that is tax deductible and how you're going to depreciate that expense. But, there's going to be a tax deduction that's going to happen because you're investing in an additional operatory. So you're going to take that money and you're going to make it an investing activity. And then what's going to happen is the goal of that investing activity is to increase your income. So then your income is going to be higher, but also the value of your practice is going to be higher because it's more valuable, it has more operatories, it does more revenue, it has more profit. And so then you are going to have that return on investment in two different ways. If you invested in the operatory, you're going to have the return on investment in more income. So there's going to be a cash on cash return. And then there's going to be a value that your practice is worth more. So let's just say you are able to go from 1.4 to 1.6 million because you added that operatory, which would be a very typical number. Then I would say, okay, well, on a yearly basis, I have a cash on cash return and how much more income I'm making from that $20,000 operatory. But then I also have a net worth gain of $100,000, or in this case, probably like $150,000 of my practice is worth $150,000 more because it's doing more revenue. It has more profit because I built that operatory. And so that's why a lot of times, obviously a $20,000 expense to build an operatory is like a pretty high ROI situation. So it's not like we're looking at, something different, but I would say marketing spend could be a great mindset to have this as well, or coaching, consulting. Or, you could think about, equipment, for example, maybe you're going to drive, maybe you don't have a cone beam and you want to add implants to your practice. You could consider you could do it one of two ways. You could pay cash for the cone beam, or you could finance the cone beam and take on a monthly payment, which would increase your financing obligations. And then you could potentially grow revenue and have a higher valuation and all of those things. And so I tend to be of the mindset that, your cash is best spent investing in the practice so long as there is a compelling return on investment. And I think the last thing I want to talk about in this episode is this idea of cash on cash return, right? So if you think about, I like Kevin O'Leary from Shark Tank. He has this funny thing of his dollars are like soldiers, and he sends his soldiers out on a battle or on a mission, and then he expects more soldiers to come back, right? Like he kind of uses that term sometimes. And I think that the more time I've spent in the finance role, have I learned to appreciate that cash on cash is the truth, right? So if you are sending cash out, the most effective way to justify that investment is cash coming back. So let's use this 20,000 example, right? So we have a $1.4 million practice. There's an operatory that's plumbed but not equipped. It costs $20,000 to equip it. how are we going to get a return on that investment? Well, the return on the increase in the practice value, you don't get that cash, right? That's paper money. It's practice 01k balance, but you have to sell equity in the practice to get your cash back. Versus the income, that's a cash on cash every year. So if we say that we added, $20,000 to build out that operatory, and we were able to add $200,000 of collections because of that operatory, then I would say that, you would say, well, what's the profitability on that $200,000? And you would say it's probably around $40,000 a year, right? You're probably making an extra $40,000 a year, just maybe conservatively. And so you'd say, okay, well, I spent $20,000 and I got back $40,000 per year every year. You think of how good of an investment that is. Imagine if you put your $20,000 in the S&P 500, by the time you pay taxes on it, it goes down to $14,000. You put your $14,000 in the S&P 500, and if it performs well, you're really only making like 10% maybe, which is $1,400. Versus in this situation, I put the $20,000, I still have the equipment, I still have the built-out operatory, plus I have $40,000 per year in income increase. That's it's hard to find that type of investment in your personal life. And so that's why I tend to think that in most situations, if there is a compelling cash on cash return, which means like marketing is an excellent cash on cash return, which is like you spend money on marketing, you get patients at a specific acquisition cost, your revenue per patient is higher. So you pay for the marketing spend and you have extra profit. You could very well see let's just say you think of $60,000 in marketing spend, $5,000 per month for a given year. If that adds, let's just say you get like $150,000 in new collections on that, maybe you're getting an extra $30,000 in profit, right? That's a 50% return on the $60,000 investment because you're paying for the entire investment, plus you're getting an extra $30,000 in profit. That's a really good return, and you're keeping those patients in your practice longer term, right? So I think, and obviously coaching, for us, we have a lot of data for multiple years in a row that we can grow somebody's practice by 37%. So if you look at, okay, well, what's the total annual cost? And then what would my practice do at 30% more revenue? It's a very compelling return on investment, right? And so those are the types of investments, and there's many others, right? There's lots of different things that you can do to invest in your practice. And what you need to look at when you're evaluating that is, yeah, sure, you can increase the value of your practice. But increasing the value of your practice doesn't give you cash back. It gives you practice 01k paper wealth balance. But what really gives you cash back is the cash on cash return. And so if you noticed in this episode, I'm kind of wrapping up now. We've talked about finance, but we haven't talked about any actual overhead, right? You think if we're doing a financial episode, we were going to talk about staff overhead percentage and rent and marketing expense and payroll and all of those things. It's yes, that could very well be a future episode. And if that's something you're interested in, I would reach out to team@sharedpractices.com and give your feedback on future topics that you would like. But at the end of the day, I think that the thing that we're seeing in the mastermind is that there's a lot of, I remember I went to this one conference and we spent the whole 2 days and there was 4 or 5 hours on dedicated to overhead. And it was I think overhead is one of those things that's very talked about. And I think the way that we manage cash and business bank accounts and income statements, balance sheets and cash flow statements and investments of cash in the practice and the return on investment and the cash on cash return and some of the things that we've talked about in this episode, I think that those are maybe less discussed. And based on my conversations with our mastermind, I think those are some of the areas that people need a little bit more help. And so I decided to take today's episode more on that direction rather than overhead percentage direction. But naturally, I have a whole framework from Dental Moneyball, the first book, that talks all about what I call the buckets or the financial waterfall of a practice, where you're going to have your operatory expenses, like your supplies and lab and associate compensation. And then you're going to have your fixed expenses, like your rent, your subscriptions, your operating expenses, plus your team and your payroll. And then, you're going to have growth costs as well, right? So I have a framework for going through overhead as well. And I would say that if this episode is well received and you guys want me to go through that, I can do another episode just focused on overhead and profitability, which is zooming in on the income statement. But from my conversations with the mastermind, more of the concern is how do I manage cash? How do I make intelligent decisions with cash? And how do I use cash to make more cash? And I'll end with, I'm a big Warren Buffett fan. Like, it's hard not to be. And he has a statement that I think really applies to dentistry. He says, the best type of business is one that generates cash and then takes that cash, invests it to generate more cash. And it's like, it's kind of simple when you think about it. But if you just think about that, like, there's a lot of truth to that, right? So like this applies to, I've talked about many different examples, but let me give you another one where it's like, you generate cash through your income, then you take some of that cash, you invest it in a hygienist. A hygienist sees more patients, allows you to have more production, and generates more cash, right? So that's like the perfect type of investment, right? Because it's like, I used my cash flow, I invested it, and then I got more cash as a result of that investment. Now I have more cash to invest, and then I do that again. And it can begin to compound quite dramatically. I think that that's kind of summing up our episode today. You know, we talked about the income statement. We talked about the balance sheet. We talked about having 1 month break even. We talked about paying yourself quarterly in addition to like some type of set amount salary or something monthly. And then we talked about how to decide what to do with your quarterly cash, how to evaluate return on investment, and really thinking about cash on cash where you're sending away your soldiers, you need more to come back. If you confirm that every time money goes out the door, there will be more money coming back in the door, it's really hard to go wrong. If you invest money and you say, okay, I'm going to spend all this money and then it'll be worth much more, it's harder to get the return on that investment because you have to sell in order for that to come back. And so the cash on cash is like the truest way of making sure that these investments are solid. So hope you enjoyed the episode. Team@sharedpractices.com if you want us to go through more overhead related topics as well, or any financial questions. This is going to be a door that I open up on the podcast, similar to leadership in the past. It's just kind of finding these areas that people want to hear more and more about. So email us, team@sharedpractices.com. And thanks for listening to another episode of Ask George. Here we talked about how to manage the financial side of a dental practice. See you on the next one.
Resonate.